Hey everybody, welcome to Wealth Unfiltered. I'm Samantha Parrinello and I am your host, and I'm here with my resident guest expert, Chris Parrinello. Today we're super excited because we have a really special guest. For all of you passive investors, active investors, this is an episode you don't want to miss. We have Don Goff, and he is the principal of Next Level. Guys, we got to start over. I forgot it was capital because it's not underwriting, right? It's capital.
That's it, yeah. Capital, yeah.
Okay, everything I had said underwriting, and then I was looking again at your LinkedIn, and I was like, "This says capital," and
Oh,
I
yeah,
knew it
that's
was
my
something you
under.
were
Yeah,
saying.
so, all right, so that might affect your questions. So, because Next Level Underwriting is a program I created for RE Mentor for people.
Hey, everybody, welcome to Wealth Unfiltered. I'm Samantha. I'm your host, and I'm here with my guest resident expert, Chris Parrinello. Today, we're very excited because we have a very special interview for you. We have Don Goff, who is the principal of Next Level Capital. So, welcome to the show.
Oh, thank you. I'm glad to be here. Thanks for the invite.
Yeah, we're really excited. I know that you've worked very closely with Christopher, but this is my very first time getting to meet you, so I'm grateful for
Yes.
the opportunity.
All
We're going
right.
to dive right in. I'd like to ask you a little bit about your background. So, if you can give us a little bit about your real estate journey, how you ended up working with RE Mentor, and then most recently, how you started Next Level Capital.
Great. Yeah, well, it's funny how I got started in real estate in general. Someone asked me, they were already doing some small multifamilies and they said, "Hey, if I next time I come across a good deal, is that something you'd want to take a look at?" And they didn't know I was watching them the whole time, and I really wanted to get in because I wanted more passive income at the time. And then from there, we just started educating ourselves and going to the local real estate club meetings and so forth. And that's how I met the founder of our mentor, Dave Lindahl, and got involved with him, got into more larger multifamily properties. And then I became a coach for him. So I've been coaching for RE Mentor now for just about 20 years and have coached hundreds and hundreds of people around the world on how to actually start up their real estate business from the ground up by raising money, finding the deals, underwriting the properties. And so that's pretty much how I get started and where I'm at right now. And I'd love to answer any other questions that you have for me.
Yeah, I think this is a really great time to kind of bring up that an interesting kind of connection here is that Vikram and Ravi, our principals, were one of your clients, and you were actually their mentor when they were in the very beginning stages of Viking or even before Viking.
Yes.
Can you tell us
Oh,
about
yeah.
that?
It's
What it
right
was
when
like
they
working with
started
them?
Viking. I think they started Viking shortly after that, or towards the end of our mentoring.
Yeah, so tell us, like you had a front row seat to kind of Vikings growth and who they were before they became, a company that has a billion in transaction volume and 850 million under management. What's
Yeah.
that journey looked like from your seat as one of their mentors?
Yeah, well, I loved working with them and they have two different personalities and they had such a good cohesive partnership the way they had it. Like Vikram was kind of the front end guy and Ravi was more the details guy. Like I have an engineering background, so I was always the details guy. So I would always get into the details with Ravi and then Vic would always want to hear more about how do we expand, how do we grow, how do we, and so it was great because they satisfied both ends of the business and they wanted to grow fast. I kind of had to put the rein. I felt like I was putting the reins on them a little bit, right? To say, all right, let's make dot our I's, cross our T's. But they really picked up everything so fast, and they had some background investing in before that. So, but they grew. I was blown away how fast they grew. They're probably, if not the most successful people that came to our program, pretty close to the top there. I just when I started watching them after, a couple of years later, and we kept in touch here and there. I was like, oh my God, I can't believe how fast they're growing. So I was super impressed by their growth.
How important do you think it is for people when they first start out in their investment journey to find a coach, a mentor, or training?
Yeah, it's critical. It's really critical. And it's funny because I'll have some people come in and say, I really understand numbers. I understand underwriting and all this. And that's great. CPAs, people are really good in math. People have MBAs from, Georgetown, Northwestern, coach people on Wall Street. But there's nuances in multifamily. You're going to know the details and the nuances and what to do in this situation, that situation. So, I've seen it hundreds and hundreds of times where just one phone call that we had was a game changer in their business, like saved them 50,000, 100,000, because some of the best deals you get are the ones you don't get, right? Because you understand there's some issues there.
Yeah, that's incredible. And that's something that we noticed too. I was I came from a little bit more of an institutional background. So usually the people that I was working with to capitalize our deals understood real estate in many ways better than I did. But when I started working with the investors at Viking, I noticed that incredibly intelligent people, all highly successful, but they spent their careers working in other areas and becoming experts in medicine or traditional equities and really understanding where risk was in real
Mhm.
estate was a blind spot for them. And
Yeah.
and that's something that I think Viking has tried really hard to kind of teach and educate and bring to the forefront. And that was one of the reasons why when I first originally talked to you, I was floored because I was like, oh wow, like, he gets it. He's doing the exact same thing.
Yes.
So when you talk about, you teach about risk, you talk about the deals that maybe didn't pan out.
Mhm.
How do you, when you structure your help or your coaching for them, how do you help them identify the right deal or the market to find, like to go and invest in?
Yeah, well, we always start with the market first because you want to be in a market that's growing, and we go emerging market, right? And it comes down to basic supply and demand, right? It's a little bit more complicated, but that's how I break it down at the beginning for people because it has to be growing. And with growth of the market through jobs, which creates population growth, which creates demand for housing, right? Demand for housing and rents go up because rents aren't going to go up if there's a lot of supply and people have a lot of choices on where they're going to live. So then rents go up, and that's what creates the value. But it also mitigates your risk because if you're not in a declining market, then now you have a growing market. So that mitigates risk, and it also helps you to you want a diverse economy. You don't want to go in a market that just has one company there, one big company. I mean, Detroit's an extreme example, but look what happened to them. Once the auto industry moved out of there, it decimated the area. So if you can find balance in that, so that's first thing is the market. Then as far as deals, we like cash flow and appreciation. I call it the best of both worlds because you're getting some money along the way. It's like a dividend, but you have the upside potential of the property. And again, that takes off risk when you have the cash flow because of the fact that, if you're doing, flipping properties, there's no cash flow. New development, there's no cash flow, but you can mitigate your risk there too. But what I love about the buy and the holds is that you have that cash flow. You're going in with cash flow. You're going in with a track record already to see how the properties have been performing. And then now, but investors also get to get involved with the upside and the appreciation of the property.
Yeah, we were actually just our last podcast, which hasn't aired yet,
Mhm.
was with Spencer Levy from CBRE, and we were chatting with him, and he had a really interesting approach to look at real estate investment. He basically boiled everything down to, when you look at the reward risk spectrum, the safest investment is going to be, like a municipal bond or a treasury bond, and he's like, you love that because you have consistent yield. And
Mhm.
he's like, the miracle and the beautiful thing about the real estate, whether it's multifamily or other asset classes like industrial, retail, is that you're basically protecting yourself by getting a fraction of the yield that you get from a bond, but then you're choosing how much additional risk you're willing to take for your within your risk appetite,
Mhm.
and you're kind of supercharging those returns on the bond yield with backside appreciation. And he's like,
Yep.
you get to decide where you land.
Yeah.
If you want the 4 or 5% you get in a treasury bond, you find a multifamily value add deal. It's not core where you might not get as much cash flow, but you get 4 or 5%. You're getting what you'd be getting in that treasury if things go according to plan. But then you might get another 10 or 12% on the back end when the deal sells. So he broke it down so beautifully, and
Yeah.
you
I love,
really
I love that.
put it in a way to where like almost as a coach, and it is really really interesting. I love
Yeah.
those
No, I
dynamics.
love that.
So speaking of coaching, what kind of questions are the most common questions that your clients come to when they're first starting?
The biggest one I get is it the chicken or the egg? Do we raise money first or do we find the deal first? And since they're just starting out, a lot of these people and learning the industry, I used to think it was a chicken or the egg when I first started coaching because I didn't have a lot of background, obviously. But now that I've been doing it almost 20 years, I figured this was a long time before that. But it's really, I focus on the deal first. And the reason I focus on the deal aspect, because I really break it down into the two categories, finding the deal and funding the deal. And then everything kind of falls underneath that. Um, and I focus on that first because it takes some time. You got to build relationships with brokers to be able to find the properties. And that's not going to happen overnight. and you got to learn the underwriting. And the underwriting is a critical piece to the whole business. Underwriting affects how fast you can get to the broker, whether you make money or lose money. Communication with, say, if you're partnering with someone else, going to communicate that with them or your investors to understand the numbers. So I want to get the foundation there and really understand the terminology and the numbers. And then 30, 60 days in, then we focus and then we start shifting more of that to the money side. So that way, because it takes time to build those relationships as well. But that's the biggest one I get all the time. What do I do first? Do I do both at the same time? And I'm a momentum guy. Like I want to build momentum in a certain area, right? If you're trying to do two or three things at once, it's hard to really get going. So that really helps them get going, knowing their market, making sure they're even in the right market before they can talk to investors, right? Being able to explain why this is a good market, why I'm in there, because that helps, like we just talked about, mitigate your risk.
I have a question for you. So
Yeah.
when in your experience with the thousands of people that you've coached, what is the biggest kind of shift in like the expectation they had coming in to where they felt they were like 90 days later or 180 days later?
Yeah, the biggest shift I would say is, to be honest, it's personal development stuff. It's not even the real estate. It's being intentional with your time. I'm very big on that because most people coming in, everyone's busy. And I tell everyone that because they say, "Oh, I've been busy doing this, busy. I'm busy." I'm like, busy doing what? My mother's retired and she's super busy. She's more busy. I can't pick up the phone for me sometimes. I'm like, so everybody's busy. You got to ask yourself, busy doing what? What kind of priority this is for you? And you have to put some time in, you have to block it out and be consistent with it. So that's one of the biggest challenges or the mind shift that they have. Say, man, I can't just do this, a couple hours here, a couple hours there. I got to treat it like a business. The beauty of this business is you can get in part-time, right? You can't do that with a lot of other things. You need $1 million just to, get a space, inventory. And with this, people that are looking to get out of corporate America or whatever they're trying to do, leave legacy income, they can start at part-time, 10 to 15 hours a week, and start building, start building the business. But you have to be consistent and treat it like a business. That's the main thing.
Yeah, absolutely. So when you're talking about, helping them build a business, how do you help your clients scale their portfolios?
Well, the first thing that they're going to do is we got to figure out how to get enough deal flow coming in. I know you guys look at a ton of properties, and you have to be getting deal with. That's how the main way you're going to scale that. So we do that first, developing broker relationships, going to the market, right? How many times have you met somebody and your relationship got better? Well, sometimes it gets worse, but most of the time it gets better. And you go to the market, and then you're going to get more deal flow. So you're scaling up on that end. And with investing, a lot of people are going to start out with your local, or not your local, but your immediate network. But then we got to expand the network, right? We got to start going to networking events and talking to people, finding people that are interested in making a higher return or looking to diversify their portfolio. So giving them some structure as far as that goes to increase their deal flow and increase their investors is the main way I help them to scale.
Yeah, that is such great advice. As I navigate through, my role with Viking and I look at how successful our VP of acquisitions is with his broker networks, and what I realize, and as I talk to, more institutional people, everyone in real estate is like, this is a relationship business.
Huge.
And, whether you're dealing with a lender or you're dealing with a broker or you're dealing with an investor, people want to work with people that they like and then people that they think that are capable and then people that they think, that they built some level of trust with.
Yeah.
And you can't replicate that without going to the market and meeting with brokers and then not just meeting with brokers, but giving them feedback if you pass on the deal, letting them know why it didn't work for you and that you were serious and that you built a model together. That's such critical advice. I appreciate that for sure.
Yeah, yeah, no problem. No, it's truth. It's you got to trust the people that you're doing business with all the time. And how can you do that just by doing it over the phone? Eventually you have to. And a lot of people do that 4 to 6 months in. I'm like, when are you going to your market? When are you going to your market? And I'm like, you have to go. You want to have the success. You got to go to your market because they don't know you. They don't really know you yet. So it's going to take you longer to get the better deals.
What kind of recommendations do you have for people who have no idea where to start when like when they're thinking about meeting a broker, finding a broker to start establishing a relationship with?
Sure. So as far as finding their brokers, we there's two commercial websites out there that everyone pretty much knows about, LoopNet and Crexy. So they're just, they're not the best where you're going to find the best deals all the time. A lot of times it's because they're put up there because they're trying to market nationally. So that way they can get the highest price. So they know local people aren't going to buy this property for whatever reason. But it gets your foot in the door with brokers. It gets to talk about something on the call by doing that. So we send them to the websites to establish relationships. Also, it gives you a property you can underwrite to practice on, because we're not trying to find the best deal coming out of the gate. Always that's how I train my clients. So they think they are, but I'm like, a lot of the stuff that out there, the brokers aren't going to send you their best deal the day you call them. They're working with other people. They will eventually, as you build a relationship, but not right up front. So let's use those to learn, you know?
And I would say that the time is now for folks out there that are looking to do active real estate, coming out of, a market with incredible tailwinds where the competition for real estate was so strong, and now you're facing some pretty major headwinds. The brokers in your area would love to take you on a tour just to be able to go back to the seller and say that somebody came out and looked and gave feedback.
Yeah.
So this is the time when they're hurting and they don't have their flow of interest to go in there and build relationships, even if you don't think you're going to be able to buy a property for the next 6 to 12 months. Get out there, meet people, and start building that network right away.
Yeah, great advice. I share that all the time because there are frustrations. It's not happening quite as fast as people want, right? And and you, but building the foundation now, so when you do have the more opportunities or more properties are starting to come on the market than might be right now. Well, now you're ahead of everybody else, right? You're not at the starting point. You're ready and you're waiting for those deals. Your underwriting's good. Your money's raised. You planted your seeds with everybody, and you're ready to go.
So I've asked you, and Chris has asked you a bunch of questions, I think more relating to your coaching with RE Mentor, but I wanted to kind of circle back to how and why you created your company
Yes.
and what was kind of like the inspiration for doing so.
Well, I'll start off with the inspiration. It was actually Viking was the inspiration, to be honest. I've been getting newsletters from you guys for a while, and I always love the information. And being in the industry so long, I don't learn from many people, right? Just because I've been exposed to so much, especially through all my clients and everything. And look at the newsletters, learn some information. It was great information. I loved how you had a team around it. And so that's when I first started, well, before the Next Level Capital started investing with Viking, because I knew Vic and Robbie, because I coached them. Like you said, you needed some sort of level of trust. I saw what they did, but I get to work with them for a year, and not everyone's going to have that opportunity. But that was my opportunity. That's what I saw, and then, like I said, because you're providing that educational piece like that, and I looked at what you're consistently doing, and I saw in your marketing the success. Because in and out, I'd look at it here and there, and then I started paying more attention. That's when I said, "Man, I want to really start to invest with these guys and look at more about that." And then as far as Next Level Capital goes, after investing in a few properties, and my sister got involved as well, then I called Chris. I was actually at a wedding, and it popped in my mind because we were talking about a property. I'm like, hey, I wanted to have you guys ever partner with people that raise funds for the properties. And he said, yeah. So we just started the conversation, and then it went from there. And that's when I really created Next Level Capital, as because I wanted to get more into doing this. I don't want to go out and personally, I've been in the industry 20 years. Don't want to go out and buy properties. And I know a lot about the industry. I have a lot of contacts in the industry, but I want to consider myself more on the back end where I want to get those great returns, but I don't want to do the whole business. And like I said, you can do one aspect, like I coach my students at the beginning. So that's what made me really want to raise capital. But I waited a long time. I thought about it in the past, but I wanted to hang my hat at the right place. Your network's everything to you, especially after building it for as long as I had. So I did have to have some sort of level of trust, and as getting to know Viking through the investing part of it, and seeing the communication, the transparency, super important to me. Because I've seen so many things go bad in the industry too, with all the exposure. So I had to make sure that I felt comfortable with that, and because transparency is fine. it's a business and not everything goes perfect all the time. That's, not realistic. And once you communicate about it and, and you can fix those things and move on.
Yeah, absolutely. And I mean, you've been the epitome of a perfect partner. And we set up this program of working with other funds that kind of collate capital to partner and to work on these projects together. And really love working with people that have the same mindset of growing your investors, also their institutional knowledge of how these deals work. And I've had the pleasure of speaking with some of your folks, and they're all really bright people that really appreciate all the extra work that you put in to help make sure that they're getting into the right deal. So really love what you're doing there, and pleasure to be partnering with you.
Yeah, well, and that's like you said, you have to like the people you work with, and Chris is hard not to like. So, when I first reached out to the Vic room, and then, he said, "Hey, I'm going to connect you to Chris," and he did, and then we started talking, and then, but when I had questions or on certain things or want to get things going forward, he was always boom right on it all the time and getting back. And if he couldn't, he let me know. Hey, I'm jammed up today. I'll get back to you tomorrow. I love that because most people don't do that. It's something really simple, but I just want to know, where do I stand? Can I move on to my next thing? So yeah, so it's been great since we started working together. I've really loved it, and so I'm looking to continue to grow the relationship. Even looking forward to meeting you pretty soon. I'd love to come down, like I said, in March to visit you.
Yeah, that'll be great.
So you touched a little bit about how you invest personally, in addition to, raising capital. What do you consider yourself as far as like your risk appetite? Are you an all-weather strategist? Do you like to always just keep on investing and see what happens, or are you a little bit more reserved?
Yeah, well, a lot of it comes down to the property. So if you're in a good property, I mean, if you're in a good property, I'm more about, and again, I love this about Viking, capital preservation. Capital preservation, because if you use your capital, you're out of the game, right? So we all know no one could predict COVID, what happened with COVID, so if you're predicting 20% AAR and I only get a 10% AAR, I'm fine with that because no one can predict that, and you're preserving your capital and so forth. So that's one of the biggest things as far as for me investing is, capital preservation and really understanding. I know Viking's starting to get into a little bit of new development stuff. Not my background. And, when you're not educated on something, there's two ways and I, again, go through this with my students. How do you overcome your fears? By educating yourself and by taking action. There's two easy ways to do it. So, I've been getting educated more on that. I've been getting more and more comfortable because I just didn't understand it, right? Because it wasn't my niche. So, some of the risks and so forth. So, I like to take what's called calculated risks. I got to look at everything and say, all right, well, and how do I mitigate it? Do I mitigate it the best I can? You're going to have some risk. If you're making double-digit returns, you're going to have some risk. If you're not, yeah, you're going to put your money in a CD or keep it in your bank account. I mean, you're not going to get double-digit returns with zero risk. But if you mitigate it and you take calculated risk and everything makes sense, and people have a good track record that is sharing the opportunity, because that's one of the other biggest things I share with students is it's not the numbers, it's not the offering that you're getting, it's the people behind it. I can put anything that I want on a piece of paper. It's can they achieve it? Have they done it before? What's their experience? Do they have the right people in place?
Yeah, and this kind of reminds me of something that happened at NMHC. We're sitting in a meeting with American Landmark, and they're a really big multifamily firm. And their CEO, Joe Lubick, was kind of giving us his thoughts on the market and all of those types of things. And we asked him, what do you think about new development? Because we have this deal that we're doing in Peoria. And he's like, not everyone feels this way, but I do new development, but I have distinguished new development versus new build. He's like, I'm not a developer. He's like, a developer is somebody that goes out there, buys land 3 years ahead of time, goes through the brain damage of getting it entitled, working with the city council, doing all of these things. He's like, I focus on new build, which I believe dramatically reduces the risk. I get involved when a developer has already gotten that stage done. And that's kind of what we are doing as well. We didn't realize that
Yeah,
that
I
was
didn't
what we were
either.
doing, but when he broke it down, we're like, oh, that's exactly how we see it too, which is there's going to be a developer who that's all he does. It's his bread and butter. He's done 20, 30, projects. He gets in and then he could work with a company like Viking that has the capital and we can lean on that relationship. And they've already gone and reduced the entitlement risk by 90%. Be ready with permits, or in some cases, you find an opportunity where a developer thought they could bring the capital to a deal, have a great track record, but they didn't have the relationships in order to fully capitalize it. In a time like now where the institutions and family offices are a little bit more skittish, it's tough to get a development deal through investment committee. So flexible capital is really useful. Um, but yeah, I think that development is a new chapter for Viking too. And what we see is in the interest rate market and in the cap rate, kind of ebbs and flows, that there's a time where it just doesn't make sense to acquire. And as much as we acquire, and that's our main mode of business, what we found through some challenges and some mistakes is when you see properties trading at sub four caps, that you might want to take advantage of that historically low debt and develop.
Yeah, no doubt. Well, that's the other big thing that I learned. It's similar to there are better times to get into the different niches, and that's one thing that going through you and talking to Michael and having a call and educating me a little bit more on it. It's similar to the multifamilies. It's just in a different niche. Watching the markets, watching the permits, watching the timing of how many properties are coming online at that time mitigates your risk because
Mhm.
it all comes down to your competition, right? So that's yeah. So that's I can see how different phases now are really good for development versus some phases might not be. So it's nice if you have two different strategies that you're focused on because then you can cherry pick, all right, we're going to lean more of our business towards this unless we get a really good deal, more towards the development for a little while until the dynamics out there change. And then when they do change, you watch where it's not going as favorable in development, then you switch back to your other model.
Yeah, and I mean the truth of the matter is that you're never going to get a better basis than building it yourself.
Yeah, yeah, that's
So you
true.
both mentioned when you were both speaking, you're talking about risk mitigation, right? So when you think about it for your own, also I guess when you're coaching, but specifically when you look at your own investment strategy, how important is it to you to diversify your portfolio, whether it's asset class, regions, like how do you go about it and how important is it to you?
Yeah, I think it's good. I like to have economies of scale, so that's another thing I liked about Viking and getting into some of the projects in Atlanta is because you already have a team set up. That mitigates risk, right? You're not doing new management company, finding new teams there. So I do like that, but at some point, it's nice to stop looking somewhere else as well because you don't want to have if you have 24 properties, you want to have 24 in one market. You want to diversify some out just because different things can happen, right? So I think diversification is really important as far as have a certain amount, but I also think economies of scale is good because that mitigates risk. So you can buy X amount of properties. There's no specific number in a certain market, but also at the same time stop looking at another market to see that because it's going to be in a different market cycle than the current market you're in anyway. So you can kind of do both in parallel, and that's again I talk about momentum is have a first priority market and then a second priority market because all of a sudden, if you're in the market and you already have five properties there and a smoking deal comes along, it's not a super risk because a lot of it comes down to the property. If you buying the property right, even the market can take a hit and you're still going to be okay because you bought it right and you're not over leveraged, right? So a lot of it, a lot of people get confused on that part is it's really about, as they always say, you make your money when you buy.
I couldn't agree more. And that's that you want to be careful not to chase the shiny object. I think some people hear diversification and they're like, great, I'll do everything. And you want it to all be interrelated. So
Yes.
we felt like multifamily acquisitions and multifamily development was a nice strategy. Um, but uh, but yeah, the economies of scale, that's important in more than just having like a team on site. It's also in the same, like you have all this knowledge about multifamily. you might have to look at it through a different lens to look at development versus acquisitions. But a lot of the stuff you know is still the pertinent information. So
Yes.
if you feel like you're an expert on multifamily, you just have to figure out where the risks are in the different parts of the life cycle.
Well, that's what I love too about you guys is just staying in your lane and partnering up with the right people, and also having experts on your team that already have a background in that. I mean, that's really important as well. It's not like you have no one in your organization that never done development before. Obviously, that adds risk to it, right? But having that asset plus the background in real estate, because like you said, it all kind of flows together. You might have to find a few of the different nuances and the risks, like you're just saying, hey, if it's already the difference between a builder and a developer, if you already took out that big part of the risk up front, that's one thing you nailed, and then you just you move on to the rest. So it's yeah, that's a great way to put it.
Well, and then when we talk about diversifying strategies, that I think is a really good segue into why and how you created the next level capital. And so you were diversifying your strategy into the capital raising business. And so for
Yeah,
me, I guess what I would like to understand is if you could maybe talk about how like how you created the fund of fun and like how you work with Viking through that. Maybe for our listeners who don't know what that is.
sure. Can you say the first part of the question again?
Sure, just diversifying your strategy is why you have next level capital. So just
Oh,
kind of like
yes.
how you created your fund of fun and then how that then works with
Yes.
Viking.
Yeah, I'm always looking at multiple streams of income. I don't know what's going to happen. I mean, coaching for a long time, I don't see anything happening, but I like to have multiple streams of income. I want to be more engaged in the market as well than I had been for a while. And so I think it's very important to do that. But again, I didn't want to go out there and do everything. I didn't want to do all aspects of the business. And I understand the business. I have my own underwriting course that I teach people with, so I really understand the numbers and wanted to get into that. So the fund of the fund is, and like I said, not too many people educate me, but Chris and Viking educated me a little bit on some different things on structuring, how things should be structured. And obviously, the SEC is a watchdog in this industry, and it's great because it keeps everybody on the up and up, and we all want to work on the up and up. But decided that that is the most cleanest way to do things when Chris and I were talking is to create a fund of a fund. And so learning more about it, and obviously um, you guys had contacts and people that could help facilitate the fund of the fund. That was big. I didn't have to go off on my own and figure it all out because obviously it would have taken a lot more time and a lot more bandwidth. So having some experience and having some leverage there for time and learning that. So set that up with the company, TribeVest, and that helped a lot too, as far as just having that all in place. But created that so now I like the fund of the fund because I'm the liaison. I'm the liaison to my own people, and I've always taught my folks that when it wasn't structured this way, that you want to be involved because sometimes they get involved with people they might not have long-term relationships with, right? Because you want to, that's your role. They're trusting you, they're coming in through you, so then you can be the liaison to share the information, what's going on, and so forth. And so again, it gives you another leverage with Viking to, I get supplied the information from Viking. I can communicate it with my investors, and but they trust me and they want to hear from me. So it works really well. I like it.
Yeah, it's been a great tool. And the things that I loved about it are all the things you mentioned. It compliance was huge for any kind of program that we were going to set up.
Yeah,
And that made me feel really comfortable. I can't tell you, when I talk to fund managers, investors, because we always want to make sure that we're accessible. You had one of your investors flew out to Vegas to meet me at NMHC.
I know,
And
that's great.
I was totally
I
blown
was too
away.
when I found out.
I didn't even I got to the meeting and I didn't recognize his name. It went through my team. So I
Yep.
got there. I didn't even really recognize him. He's like, "Well, I was on a Zoom call with you last week." And I was like, "Oh my Lord." And he's fantastic. And his level of due diligence was so great. He told me before he left, he's like, "Yeah, I'm gonna invest in Peoria, but I was like, I have a meeting next week with the mayor and the city
Yep.
council. He's like, I want to know their vision of Peoria and how this is going to plan out. I trust and verify. And I was
Yep.
so impressed with him. But he totally got it. He's like, look, he's I like Don does all this extra work that I would never get through his fund of a fund.
Mhm.
And being able to sit down face to face and look and meet you was something that I needed to do. But he's like, I understand the value that I'm getting. And that's the reaction I get from most of the investors that are working in this structure. They don't want to spend the 10 to 20 hours doing all of the due diligence, and they want to work with someone that they've built trust with that they think is going to steer them in the right way. And it's fantastic for the industry.
Yeah, well, with him, I think I trained him too well.
Yeah.
Always get everything in writing, all that stuff. And no, he did a great job. But I love it. I love seeing that. Some people would be feel weird about that, because if we didn't doing a fund of a fund and then their investor goes and meets with the company, I didn't worry about that at all. I didn't, when he came back, he didn't tell me before he went. And I think that's a great thing. He went and talked because I trust, like you said, it comes back to those trust things. I know you guys, everyone wins here when you're doing the fund of the fund. I'm not saying going to say that it works like that everywhere, but I know it does here just because everything that we talk about, we do. And that's a big, that's really important for me. So I'm glad he went out and get to meet with you and talk with you. And but people want to feel comfortable. They're gonna be invested in a good chunk of money. So I highly encourage that. Again, the face-to-face meeting.
So
Yeah.
yeah, I was going to mention to you. So he obviously is still doing due diligence, but is like very keen on doing it. Is that something he learned through you? Because I know you coached him through the RE mentorship, right?
Yeah, yeah. I mean, so he has some on his own that some people are more conservative than others and want more details. But yeah, that's a lot of the stuff I cover. With people, you want to cross-reference everything that you're doing. If you have the opportunity, especially since he lives in the market, why not? Why not? If you're putting a good chunk of money down, then that's good. So, like Chris was saying, having someone like myself as their liaison, I have trust with them. I've coached a lot of them for a year, 2 years. They know what I've taught them and the detail I go through of sharing what they should be doing. That's what I'm doing as well. And so yeah, so that's really important to do all these things. And I did go through a lot of those details, and it's just funny when they use them against you. Like I said, I'm like, all right, yeah, I did teach you that. Maybe I shouldn't have. No, I'm kidding.
That's too funny. Well, the last question that I have for you, I would like to know a piece of advice that you would give to somebody who's just starting out in their real estate journey.
How are they starting out? Are they starting out as just an investor? Are they starting out? Do they want to build their
I would
business?
say build a business.
Build a business. Get educated. Number one, get educated. It streamlined the process so much. Like having someone give you a step-by-step plan on how to go through it and is really critical. And even some of my students that don't want to be and own their own business, it's still good for them to know and for me to train them how to identify good underwriting, right? How to identify what numbers do you want to look at? What numbers are important? What could be a red flag, right? So it doesn't matter if you're going to start your own business where you're actually going to go purchase the properties or you're going to find the properties and partner with somebody else, um, or if you're just going to be a limited partner and go out there and invest in properties, you really understand what you're getting. So you're again, it's a way for them to mitigate their risk. So education is the key and to really learn and understand those things because it can save you hundreds of thousands of dollars by doing it.
Yeah, that's amazing advice. And the advice I'd give is, for all of those listeners out there that want to get started in active real estate, there's a huge subset of people that they don't really want at this point of their time horizon. They're in their 20s and their 30s. They're like, I want to start investing passively like in my 40s and 50s. I want to build a real estate empire. And for those people, get a mentor, go to bigger pockets meetups, like meet people in the industry, go get you your first property and start, feeding the itch to participate. And find folks like Don, connect with them on LinkedIn, get mentorship because that is going to pay off and it will dramatically reduce your timeline to find success.
Yep, sure.
Well, Don, we thank you so much for your time today. I think this was so enlightening and you gave so much great advice for our
Oh,
listeners.
thank you.
So thank you for joining us. We very
Oh,
much
thanks. It's a
appreciate it.
pleasure. Thank you. It was a pleasure. It's great to be on here with you guys. And I get great information every time I listen to your podcast.
Oh, thank you.
You're welcome.
Well, to our listeners, we'll see you next time. Thank you very much. All right.